What we are doing today is I'm first of all looking at the last part of the session 1 tutorial that is actually focusing on the accounting standards, right? So most of the areas we have completed. I just need to do the last bit of it. So thereafter we are moving to the other areas like consolidation. What are the possible questions in terms of the consolidation? Thereafter, risk of the material misstatements, how to identify the risk of material misstatements. And also, so the lecturer who is doing the audit, governance, and the ethics part, he would join later, right? So he would take you through the important areas. He would do a recap of the important areas with regard to the governance and risk matters, what is there in this pre-scene analysis. Okay, so that's the plan, and also finally we'll do a final wrap up. Okay, so now let's move on to the so all these areas we have completed. Hope you participated for the first session, or else at least you watched the recorded video of the first session, right? If not, what you do is please watch that, because there we analyze the important accounting standards, okay, in terms of the examination, in terms of what is relevant for the pre-scene. Right, okay. I stop at this point. So let's move to this slide. Okay. Right. So reminding you, what I have given in this purple color is the extracts directly extracted text from the pre-scene, because I don't want to shift here and there then when I'm doing the session. So what it's mentioned under the pre-scene information is the funding to build the research and development center was obtained through a bank borrowing, right? Total borrowing increased by nearly 440 million in financial year 21-22 compared to the previous financial year. If you look at this figure, it is evident in the balance sheet, borrowings have gone up in the year 21-22 compared to the previous year. And it was mentioned that so these borrowings have been utilized to fund the research and development center. One of the key things that the company is doing at the moment is they want to become a research oriented company from a traditional manufacturing based company, right? So for that purpose, they need to have a research and development center. So obviously this would be a property, plant and equipment, right? So I think as per the pre-scene, what you have been given was there's an increase in the property, plant and equipment, as well as there's a significant value as work in progress, right? So that would be relevant with this research and development center because it includes building as well as certain equipments as well. Okay, so what are the standard applicable to this is obviously I explained to you earlier the application of property, plant and equipment standard, right? That is with regard to the capitalized cost of the research and development center. I explained when you should start capitalizing, when you should stop capitalizing, right? What are the expenditure that you can capitalize? Okay, what are the recognition criteria of capitalizing the cost? All these things have been discussed in the previous session. So in addition to that, for this particular scenario, LKS 23 borrowing cost would be applicable, as well as later on this borrowing would be considered as a financial instrument, financial liability. So the applicable standard would be SLFRS 9. So how the borrowing cost standard is applicable, because this money or the cash is funded by taking a bank loan, right? So what the standard says is core principle of LKS 23, what it says is entity should capitalize the borrowing cost if it incurs with regard to a acquisition, construction or production of a what asset? Qualifying asset. Okay, so entity should capitalize the borrowing cost with regard to the acquisition, construction or production of a qualifying asset. So what is a qualifying asset? Qualifying asset means an asset that necessarily takes substantial period of time to get ready for the intended use. Now within the research and development center, definitely there should be a building. Now to construct this building, it would take substantial period of time. So during the construction period, whatever the cost that you incur in terms of this bank loan what you need to do is you must capitalize. Remember, you must capitalize. You can't charge that to the profit and loss statement. Okay, you must capitalize. Then you also should understand uh, what is borrowing cost is. What is borrowing cost? Borrowing cost means mainly interest, but it doesn't just limited to the interest and the other cost incurred by the organization in connection with the borrowed funds. Why do I say that interest and the other cost? Because when taking a loan, what happens is you have to incur transaction cost. Things like, you have to incur legal fees, documentation fees. What bank is going to do is bank is not going to bear these expenditure. So they will reimburse this expenditure from you. So because of that, what happens is, so when you are capitalizing the borrowing cost, you have to take the interest plus the other cost. So how to capture interest plus other cost is, examiner will give you, this is the effective interest rate. So the effective interest rate may be slightly different from your nominal interest rate. Why it is different? Because it captures not only the interest cost, but also the other cost like transaction cost, what I have just mentioned. Okay. So in summary, whatever the borrowing cost incurred with regard to the qualifying asset, you should capitalize. But the other borrowing cost, maybe you have some bank overdraft, working capital funding, those other borrowing costs you need to charge to the P&L as an expenditure. Okay, so this is the important point in terms of the LKS 23. Then moving into bit detail, right? I told you at the very first session, here the idea is not just to tell that, okay, this is the standard, you need to watch this standard, but I am highlighting what are the important areas as well in the level it is possible. Not the entire thing, because we don't have time, we just have only in the last session 3 hours, today also 3 hours, right? Where maximum possible, I'll highlight the important areas as well, right? So when we are borrowing money, right, you have two ways in terms of the standard. It can be a specific borrowing, it can be a general borrowing. Specific borrowings means what? You specifically borrow this money to construct the research and development center. You know the purpose. This money, what you borrowed, is utilized for this purpose. That is specific borrowings. In terms of the specific borrowings, what you can capitalize is the actual amount of the borrowing cost what you incur minus the temporary investment income. What does that mean? That is because now once you borrow money, let's say once you take a bank loan, you are not going to utilize the entire thing on the first day itself, right? That is utilized in periodic intervals, right? So up until you utilize it, you might invest this money what you borrow in temporary investment, maybe in a savings account, maybe in a treasury bill, right? Out of that, you get certain amount of income, investment income. So when you are borrowing, when you incur the borrowing cost, when to decide how much to capitalize, you take the actual interest cost minus the amount what you earn through the temporary investment income. So what you need to capitalize is the net amount. Okay, net amount. That is with regard to specific borrowings. But certain situations you might have a general pool of borrowings. There you have number of loans or number of debt instruments issued, right? So you have different borrowing sources. You can't specifically say that this borrowing is for this particular qualifying asset. So then you have a general pool. When you have a general pool, what you do is you need to calculate the weighted average borrowing rate. Based on that weighted average borrowing rate, you decide, okay, how much should I capitalize? You decide, okay, this is the amount what I spent on the particular qualifying asset, the amount of the expenditure multiplied by the weighted average borrowing rate, and the period for which that particular amount to be capitalized, you calculate, okay, this is the amount that I need to capitalize in terms of the borrowing cost, right? I hope it's clear. Then if this particular area is tested in the examination, you also should be aware about the capitalization timeline, I would say. When you should stop capitalizing the borrowing cost, when you should stop, are there any suspensions in between? You need to be aware. So this timeline explains that, let's assume you borrowed funds on this particular date. This is the date where you borrow money. You have taken the loan. But you can't immediately capitalize the borrowing cost unless otherwise you satisfy these three conditions. For you to start capitalizing the borrowing cost, there should be three conditions to be met. Number one, you need to incur expenditure. You make the payment to the materials. You need to make the payment to the labor. You have to incur expenditure in terms of the construction or acquisition of the qualifying asset. Then you also need to incur obviously the borrowing cost. That means you spend money on the particular loan in terms of the interest. So you are incurring the interest as well. You are paying interest. You incur expenditure, you incur borrowing cost. Not only that, most important activities are in progress. So the construction activity has to start, right? With the satisfaction of all these three conditions, you can start capitalizing the borrowing cost. Are we clear? Then when you should stop? Once the asset is ready for the intended use. Okay, so now this research and development center is what is the intended use? To carry out the research and development activities. Once it is ready for the particular use, intended use, you should stop capitalizing the borrowing cost. Why do I say so? Is sometimes, let's say, even though the asset is completed, construction work is completed, company might decide I'm not going to use it. I'll wait for another couple of months. Maybe like I want to shift the other activities from one place to the other. So because of that, I'm waiting for another 2 months. Even though the asset is ready, I'm not going to use it. So the actual start to use would start on this particular date. But what I'm telling is you can't capitalize the borrowing cost, what you incur from this particular point. Once the asset is ready for the intended use to actual use, you can't capitalize. So during this period, you can't capitalize the borrowing cost, right? That is your inefficiencies. You have not started the use. So the standard clearly says that once the asset is ready for the intended use, you should stop capitalizing the borrowing cost. Now you know when to start, when to stop. Then let's assume during this construction period, because of the shortage of particular material for 1 month, I couldn't carry out the construction activity, or else you have not paid the labor on time. So because of that, you can't, so they actually stop working for a month, so that you have to suspend the activities. So once the activities are suspended, what you should do, you should suspend capitalizing the borrowing cost. Because why? Yet again, if there are no activities happening, activities are not in progress, you can't capitalize your inefficiencies. Those are your inefficiencies. You can't capitalize your inefficiencies. You should stop. You should suspend capitalizing the borrowing cost. So the borrowing cost incurred for this period, you need to charge to the profit and loss statement. By saying that, standard also gives you an opportunity where even though the activities are suspended, but if one of the three things what I'm going to mention here is satisfied, you don't want to suspend the capitalizing of the borrowing cost, you can continue to capitalize. Activities are suspended, but substantial technical or admin work is carried out. For an example, let's say this particular research and development center has number of floors, right? So then what has happened was at the initial time, once you are discussing about constructing this particular property, so the engineer said that after completing up to this stage, I want to inspect this. After I inspect, I'll give my okay, and thereafter only you can carry out the construction of the next phase, specifically mentioned. Then what you do is after completing the first phase, you actually provide the opportunity for these engineers to come and look at your premises, your construction activity, and to tell that whether that is okay to go for the second phase. So let's assume that activity took place 2 weeks time. So now the activities have been suspended, but substantial technical or admin work is going, right? Because if anyone who is doing the construction, they have to go through this process. Not only you, it's not your inefficiency. It's a typical part of this construction process. So at that time, you don't want to suspend the capitalization of borrowing cost. You can continue to capitalize the borrowing cost. Second situation would be technical or legal obstruction is there. Now, Again, if I take another example, let's take an example of a legal obstruction this time. After completing up to a particular stage, you need to take the license from a government authority. There's a legal obstruction. You have to do a registration or something. Without doing that, you can't go ahead. So what happened was, after doing the construction up to a stage, I need to now get this registration or license. So that took me another couple of weeks. So what is that? Activities have been suspended, but because of a legal obstruction. Again, that is a typical part of the construction process, not your inefficiency. You can still capitalize in the borrowing cost without suspending. Or else it is a temporary delay. Very important, it's a temporary delay due to an external event. Now, let's say because of a flood. So during the construction phase, there's a flood. For 10 days, because of this flood, people couldn't come to work. So the people can't reach the property or the construction site. So you had to stop construction activities. What is this? It's a temporary delay due to a what? External event, which is beyond your control. Again, is it your inefficiency? No, right? But you have to prove that it's a temporary delay due to an external event. So you can still capitalize in the borrowing cost without suspending, right? So you need to be aware about this. When to start, when to stop, when to suspend during the construction period, when to continue to capitalize the borrowing cost even though activities are suspended, right? You should be aware about this particular matter, right? Any questions out of this area, borrowing cost? Any question? And one more thing I want to mention now, this research and development center might have different classes of assets, right? One is construction of the building. And also in the question, sorry, not in the question, pre-scene. In the pre-scene, it was mentioned that in addition to the building, there are equipments, right? Lab equipments and other equipments are to be, other equipments are required. So what I'm telling is, for what assets this capitalization of borrowing cost is applicable only with regard to a qualifying asset, right? Qualifying asset means what? As I mentioned earlier, asset that takes substantial period of time to get ready for the intended use. Now, if you are buying equipment outside, lab equipment and all that, if you are buying outside, it won't take substantial period of time to get ready for the intended use, right? So if you fund these lab equipment purchase by the bank loan, don't capitalize the borrowing cost there. So what you can capitalize is the borrowing cost with regard to a qualifying asset. So the best example would be construction of the building, because construction of the building would take time, right? So you need to be careful there, right? You need to be careful there. Right. Okay. Moving on. I have explained what are the activities suspended that amount into suspend capitalizing of the borrowing cost, right? Example, let's say because of your problem, you have not ordered the raw material on time. That is your issue, not an external factor. You have not properly placed the raw material order. If you have not properly placed the raw material order, you have to suspend the activities. So there you have to suspend the capitalization of borrowing cost, or else you have not paid the people on time. Again, that is not an external event. You have not paid them on time. Activities are suspended. So then you can't capitalize the borrowing cost, right? There's a question on when we should suspend the capitalization of borrowing cost. So a couple of examples for that, right? Okay. Moving on. Then, as I mentioned, this particular bank loan that you have taken would be definitely considered as a financial liability in the statement of financial position. Okay, it would be considered as a financial liability. So if it's a financial liability, you need to know what is the initial and the subsequent measurement of financial liabilities. We know initially all financial instruments, financial assets, financial liabilities are measured at fair value, initial recognition. Then the other thing that you need to remember is what are we going to do with the transaction cost? Because when you are taking bank borrowings, as I mentioned earlier, you have to incur documentation fees, legal fees. There are substantial amount of transaction cost to be incurred. What are we going to do? When you incur a cost, you have two choices, no? Either to charge to the P&L, or else in case of this particular bank loan, you need to deduct from the value of the bank loan, because cash credit amount of the cost, transaction cost, debit either P&L or debit the financial liability. If you debit to the financial liability, value of the financial liability is getting reduced. That depends on the subsequent measurement of the financial liability. So to measure subsequently the financial liabilities, you have two choices. You have two categories. One is fair value through profit and loss category. The other one is amortized cost category. If you subsequently measure the financial liabilities at fair value through profit and loss category, then the transaction cost what you incur, you need to charge to the profit and loss statement, charge to the P&L. But if you measure the financial liability at amortized cost, which means other than fair value through profit and loss, in that case, transaction cost is deducted from the value of the financial liability. Actually, in this situation, the bank loan has to be subsequently measured at amortized cost. So because of that, if you incur any transaction cost, those transaction costs are deducted from the value of the financial liability. Transaction costs are deducted from the initial measurement of the financial liabilities that are not measured at fair value through profit and loss. Are we clear? So for your information, like I have included this categorization of financial liabilities as well, but I'm not going to go into detail, right? So I hope you know these areas, so you can't miss anything from SLFRS 9. Very important, right? So repeatedly tested in the exam. So just for the completeness purpose, I have included. So subsequent measurement of financial liabilities, two categories: FVTPL, fair value through profit and loss, which means at the end of the each year, you fair value and the value changes are taken to the profit or loss. Then the other financial liabilities measured at amortized cost. So when you have a financial liability, first of all, look at whether you can include that into the FVTPL category. But there are only very limited types of financial liabilities you can include under the FVTPL category. What are these? Only three items. Only three items. One is financial liabilities held with the trading intention. If you are keeping a particular liability with the trading intention, so you have to classify that under FVTPL. Or else, to reduce an accounting mismatch or inconsistency, if you designate a financial liability under the fair value option, those financial liabilities are also measured at fair value. So I'm not going to explain what do you mean by reduce or to eliminate accounting mismatch, because these financial liabilities are to be measured at amortized cost. But if you measure them at amortized cost, that would create an accounting mismatch or inconsistency. To overcome that matter, you designate the particular financial liability as fair value through profit and loss. We call this as fair value option. Once the fair value option is used, then it has to be under FVTPL category. Okay, so if you can't remember, again, I told you in the first session, even if you can understand what I explained, if you can remember the theory, that's perfect. But if you feel that, okay, with regard to fair value option, I can't remember what it is, what you do, you have to go back and do the homework, go to the particular section and refer the video, what is uploaded into the LMS, right? So this particular area, financial instruments, I have uploaded into the entire thing, entire theory with a lot of examples. I have uploaded into the revision module as well, in addition to the theory module. Okay, so you need to do your homework, right? Okay, third category or third items which is included under the FVTPL category is the derivative financial liabilities. Unless otherwise, it is used as a hedge instrument of a cash flow hedge. So if you have a derivative, let's say you entered into a forward currency contract. Okay, that particular forward currency contract, the situation is unfavorable at the moment. That's a derivative. Situation is unfavorable at the moment means it's a financial liability. So if it's a derivative financial liability, again, it has to be measured at FVTPL. So you see, only very limited types of financial liabilities are measured at FETPL. Anything which is not falling into these three categories, everything else you put under the second category, that is other financial liabilities measured at amortized cost. Actually, in this case, the bank loan, it is not held for trading. It is not a derivative, as well as there's no mentioning about reducing or eliminating an accounting mismatch so that I don't want to use the fair value option. That is not here, that is not here, that is not here. So then if it is not classified under FETPL, automatically that goes to the amortized cost category, right? All financial liabilities that are not classified as value through profit and loss, it is categorized under amortized cost. I would say 99.9% of the financial liabilities are actually subsequently measured at amortized cost. Things like bank loans, bonds, debentures, right? Okay. Are we good with that? Are we good with that? Clear? Okay, any questions? Right, look at the read the next information. What is available in the pre-scene? CAPL has invested in treasury bills and also in the stock market. Few concerns were raised by CFO on the increased volatility seen in the share prices of certain companies in which CPL has invested. So what is the applicable standard? SLFRS 9, financial instruments again. This time it's financial assets, right? Earlier it was financial liabilities. This time it's financial assets. We know all financial assets are initially measured at fair value, right? So the fair value is equal to the amount of the consideration what you have paid to acquire the financial asset, unless otherwise it is an off-market transaction. On the other day, in the first session, we discussed about the off-market transactions like zero interest loans or low interest loans given to the outgrowers, right? We discussed about that. Unless otherwise it is at off-market rate, right? The amount of the consideration what you pay can be normally considered as the fair value of the particular financial asset at the initial recognition. Here also, the accounting treatment for the transaction cost is important. Yet again, the same rules are applicable. If the subsequent measurement of a particular financial asset is at fair value through profit and loss, then what will happen is the transaction cost you charge to the P&L. But if it is measured other than FETPL, which means it can be fair value through other comprehensive income or at amortized cost, in those situations, the transaction costs are added, capitalized into the financial asset itself. Okay. Transaction costs are included in the initial measurement of financial assets that are not measured at fair value through profit and loss, which means transaction costs are excluded if the asset is FETPL. Excluded means transaction cost is charged to the P&L if the asset is subsequently measured at FETPL, and included if it is categorized under FEOCI, value through other comprehensive income, or at amortized cost. Are we clear? So the accounting treatment for the transaction cost. Okay. Then subsequent measurement. So the subsequent measurement of the particular financial asset is depending on whether it is a debt instrument or a equity instrument. So if it is a debt instrument, there are three categories: amortized cost category, value through other comprehensive income category, and value through profit and loss category, right? So it based on the conditions or the criteria or so we have actually two types of test: business model test and the cash flow characteristics. Okay, contractual cash flow characteristics. So based on the two tests with regard to the debt instruments, we have to put that under either amortized cost category, value through other comprehensive income category, or value through profit and loss category. I'm not going to again go into detail and explain, because so the entire theory is discussed, as well as I have done a past paper question where the question is available in the LMS with regard to the subsequent measurement of the debt financial assets, like things like we invest in the treasury bonds. We invest in the debentures. We invest in the corporate bonds. And in this situation, so there are certain investment in treasury bills. That is a debt instrument. Okay, so this categorization, subsequent categorization of the debt instruments would be important. But according to this question, based on the information given, actually CFO is worried about what? Not about the investment in the treasury bills, but about the volatility of the share prices, which means amount what they have invested in equity of the other companies, shares in the other companies. So for that, you need to be mindful about the subsequent measurement of the equity financial assets or the equity instruments as well. So when it comes to the equity instruments or the equity financial assets, you have two subsequent measurement bases where you can use. Number one is FVTPL. Number two is fair value through other comprehensive income. What do you mean by fair value through profit and loss? You fair value the particular share investment at the end of each reporting period, and the fair value changes are taken to the profit and loss statement. On the other hand, fair value through other comprehensive income means you fair value the investment, financial asset, and fair value changes are taken to the other comprehensive income, and subsequently it is taken to a separate equity reserve in the statement of financial position, in the changes in equity statement. So this equity reserve is there in the changes in equity statement. Now, what are the rules of subsequently classifying the equity financial asset? Because there's a concern by company CFO that examiner can construct a question around from that area. As I mentioned, two subsequent measurements under the equity instruments, equity investments, but normal expectation. That means if examiner is silent in the question, which subsequent measurement basis that the company has used, so what you do is you have to go ahead with the normal expectation. Okay, normal expectation is to measure all equity instruments under fair value through profit and loss, everything under FVTPL. It can be an investment in a listed company, it can be an investment in a private company, quoted or unquoted, everything to be measured at fair value through profit and loss. Right? This could include unquoted equity investments, which may present problems of deriving a reliable fair value. Right? That is the normal expectation. So, which means if it is classified under FVTPL, it is revalued to fair value at the end of each year, right? And the gains and the losses, unrealized gains and the losses are taken to the profit or loss. And I explained earlier, with regard to FVTPL, financial assets, if you incur any transaction cost, those transaction costs are what? Expensed, not capitalized, charged to the profit and loss statement. Maybe when you acquire shares, you need to incur brokerages, commissions. Those are expensed, not capitalized, not included within the financial asset. Then, now in this question, CFO is worried about volatility. Right? He is worried about the volatility. Now, if you categorized under the FVTPL category, what would happen is unrealized fair value gains and the losses are taken directly to the P&L. Right? Then, if he is worried about that, entity might think of designating the equity instrument under the FVOCI category, fair value through other comprehensive income category. Right? Which means you fair value the investment and the value changes are taken to the other comprehensive income. And thereafter, it goes, or the total value is accumulated in a separate equity reserve. But to do that, there should be two conditions to be met. It's a must to meet these two conditions. Remember, this is actually a choice, not a must, right? What is the must? Put everything under FVTPL. But provided these two conditions are met, you can designate the particular equity investment under fair value through OCI. What these two conditions are? The particular equity instrument cannot help for trading purpose. Intention is not trading. If the intention is trading, you can't put here under FEOCI. Similarly, not only that, and both conditions are to be met, it's an irrevocable choice for this designation only upon the initial recognition. If you put under FEOCI, that's it. You can't reclassify. Irrevocable choice. And that particular choice is available only at the initial recognition, only on the first day of recognizing the particular equity financial asset. Right? Now, if these two conditions are met, you can designate that under FEOCI. But it doesn't mean that if these two conditions are met, it has to be under FEOCI. No, even though these two conditions are met, what is your normal expectation? Put under value through profit and loss. But if these two conditions are met, if you want, you can designate them under value through other comprehensive income category. Now, relating to this question, now CFO is worried about, right? So the volatilities of the share prices, because unrealized gains and the losses are taken to the profit and loss, let's assume. So they went ahead with the normal expectation. They classified the equity financial assets under FVTPL. Now CFO is worried because unrealized gains and the losses are taken to the profit and loss. I have a question to you. Can he suggest to reclassify those items that he has put under FVTPL into the FVOCI category? Can he do that? Need an answer from you. Now he is worried about the volatility because he can say that, okay, then the value gains and the losses are not taken to profit and loss, then it's included only in the other comprehensive income, not to the P&L. So can he suggest that? No, he can't. Why? I told you, if you put under FVOCI, it's an irrevocable choice, very important, only available. That choice is available. That designation has to be happened at the day one, not later on. Not later on. Are we clear with that? Are we clear with that? Understood? Right. Okay. Moving on. Then with regard to the subsequent initial and the subsequent measurement rules, if you incur transaction cost with regard to a financial asset measured at subsequently FVOCI, you can capitalize the transaction cost. You don't need to charge that to the P&L. You can include within the asset value. And as I mentioned, this particular, if the financial asset is subsequently measured at FVOCI, you revalue or you fair value the investment at the end of each year. Then if there's any gain or loss through other comprehensive income, it is taken to a separate equity reserve. Now this equity reserve, we call this equity reserve as investment reserve. This equity reserve is similar to revaluation reserve of PP&E, because if you revalue PP&E, what will happen? Current year revaluation gain you take to the other comprehensive income, then the total amount of the revaluation gain is accumulated in equity reserve. But there's a small difference between the revaluation reserve and this investment reserve. The main difference is when it comes to the revaluation reserve, you can't have negative balances. You can't have debit balances. But investment reserve can be a credit balance or it can be a debit balance as well. There can be a negative figures for the investment reserve. Understood that? Then on a future date, when you sell this equity financial asset, which is measured at fair value through other comprehensive income, the accumulated amount in the equity reserve, what you do is you need to transfer to the retained earnings, similar to the revaluation reserve, right? When you sell an asset which has a revaluation reserve, accumulated value in the revaluation reserve, you transfer to the retained earnings. Similarly here, when you sell the particular equity financial asset measured at fair value through OCI, accumulated reserve, you transfer to the retained earnings. Okay, you need to calculate the gain or loss on sale on one side because you are disposing the asset. On the other side, so the accumulated value in the equity reserve, you transfer to the retained earnings. You can't transfer that to the P&L because that is an item which will not be reclassified to the profit and loss, but it is getting transferred to the retained earnings. Right, so that's what I want to tell with regard to SLFRS 9. Then I decided Actually, today morning, I decided to incorporate these slides as well. I have included 4 to 5 slides here, which is not there in the what you call presentation I have shared with you. Because of that, I will share the fresh presentation today, because this concept of fair value is given a lot of prominence these days. And in this pre-scene, we discussed there are many places this concept of fair value is discussed, right? So what is the standard that talks about the fair value concept? What is the standard? So there's a question, once the FVTPI instrument is disposed, where you should take the profit, whether it's to be taken to the PNL and OCI. So basically what happens is, that's a very good question. What happens is, realized gains and the losses of any financial asset to be taken to the profit and loss, because once it is realized, it is taken to the PNL. But remember, FVOCI financial assets means those are measured, carried at fair value. Okay, normally what we believe is, when you dispose the particular asset, it is disposed at fair value, market price. Okay, once we look at this definition, we will understand that more, but it is disposed at fair value. So because of that, at the date of disposal, carrying value is equal to the fair value, because it is measured at fair value through OCI. So the proceed that you also get is equal to the fair value. So it is highly unlikely you get a profit on disposal, right? So the disposal proceed is normally equal to the carrying value, because the instrument is measured at fair value, right? But once you dispose, even though you don't have any disposal profit, if you have a disposal profit to be included that to the P&L, but normally you don't, right? So, but once you dispose the asset, the accumulated value in the equity reserve with regard to the previous value gains and the losses, what you have recognized, you need to reclassify those accumulated value gains or the losses in the equity reserve to the retained earnings. I hope I answered to the question. Right. Okay, moving on. Concept of fair value. So applicable standard for the concept of fair value is what? SLFRS 13, right? So what is the role of SLFRS 13? Does SLFRS 13 says, answer to the question, does SLFRS 13 says what items needs to be measured at fair value? Which items need to be measured at fair value? Is that guided by SLFRS 13? Hurry up, quickly. We have to make sure that we take the effective use of these 3 hours, right? This is the final call, okay? Final class, discussing the pre-scene in detail. So answer to the questions, hurry up. So is the standard mention what item needs to be measured at fair value? No, right? So what items to be measured at fair value is discussed in those separate standards. Now, for an example, at the very first beginning of this session, I explained about biological assets, agricultural produce. So LKS 41 agriculture standard says that those items are to be measured initially and subsequently at fair value less cost to sale. Then the financial instrument standard says that financial assets are to be measured at fair value, right? So now investment property standard LKS 40 says that if you select the fair value basis to subsequently measure the investment properties are to be measured at fair value. Then even business combination standard says that. So most of the examples what I have given is recurring fair value measurement, financial instruments, investment properties, biological assets. Certain situations you have to measure the fair value on non-recurring basis. Example, when parent is acquiring a subsidiary, at the date of acquisition, you need to fair value all the identifiable assets, net assets and the liabilities of the acquired subsidiary. That is a non-recurring basis. Only once you do it. You don't do that every year. So different standard talks about fair valuation, right? So the role of SLFRS 13 is, once this standard talks about the fair value concept, to provide a single source of guidance on how to fair value, single source of guidance on how to fair value, right? But let me ask this question, not in this slide. You can measure by yourself how much you have studied. But there are two exceptions. That means SLFRS 13 is the single source of guidance on how to fair value when the fair valuation is required by a different standard. But there are two exceptions. So which means SLFRS 13 is not going to apply with regard to how to fair value for these two situations, two main situations. What are they? Hurry up. SLFRS 2 share-based payments and SLFRS 16 leases. So the concept of fair value is discussed in these two standards as well, but how to fair value is not guided by SLFRS 13. How to fair value is also guided by the particular standard itself. Now, for an example, share options. So in SLFRS 2 share-based payments, we discussed about the share options. Fair valuation of share options are discussed in SLFRS 2, not in SLFRS 13. Other than these two situations, all the other situations, how to measure the fair value is discussed here. Right, coming back to the concept of fair value. So this fair value concept is looking at the exit price. What do you mean by exit price? Look at the definition. Price that would be received to sell an asset. If you have an asset, by selling the asset, exiting, by selling the asset, how much you get? Or else pay to transfer a liability. You have a liability at the moment. To transfer that liability to somebody else, how much you need to pay? If you have an asset, by selling the asset, how much you can get? If you have a liability, to transfer that liability to someone, how much you need to pay? Exit price. In an orderly transaction, that means not a forced sale. Okay, orderly transaction between market participants. Okay, unknown parties, no connections, buyers and the sellers. Okay, market participants at the measurement date. Measurement date can be the initial measurement date or it can be the subsequent measurement date. Are we clear with the definition? Now, this particular concept of fair value is a market-based concept. Very important. It's not entity specific. You have to look at from the market participants' point of view, not from particular entities' point of view. How the market participants are making the decision. So we believe that market participants are rational, right? So as it is from the market participants' point of view, when you need to determine the fair value, you need to use observable data from the active market whenever it is possible. Observable data means it is available for everyone, not only for the entity, right? Not only for the entity, it's available for all the market participants. Active market means there are frequent transactions taken place. Anybody can see what is the price that is in that particular market because frequent transactions are taken place. Are we clear? Right. Then in summarizing the standard, most of the things what is there in the standard in this slide. So just have a look by yourself and see that you can understand this. Can understand. Can or can't. Okay. So when you apply SLFRS 13, you need to understand what asset should I fair value. It can be a standalone asset like financial asset, like PP&E, like biological asset. It can be a standalone asset or a group of assets. Sometimes you need to fair value the cash generating unit, smallest group of identifiable assets which generate cash flows which are independent from the other groups of assets. Unit, cash generating unit, or it can be the entire business. Okay, you need to fair value. So the standalone, this concept of fair value can be applicable for one asset or group of assets. And there are three valuation techniques what is discussed in the standard. Okay, so you have to select what is the most suitable valuation technique by keeping this concept into account. Use observable data much as possible. Limit utilizing the unobservable data. and the valuation technique should be appropriate in the particular situation. So to use the particular valuation technique, data should be available. By taking those into consideration, select the correct valuation technique. Market approach means you look at the market data, recent market transactions, market prices. So based on that, you do the valuation. Income approach means you look at future cash flows. So there's an asset, that particular asset generate future cash flows. So calculate the present value of these future cash flows and you value the asset. That is income approach. Cost approach means to replace the same asset, how much of cost that I need to incur, replacement cost approach, right? So 3 techniques. And I told you the inputs that you use for these valuation techniques can be an observable input or unobservable input. Observable inputs mean it is available for all market participants. Unobservable means it is available only for the entity specific. So what you need to do is maximize the use of observable input and minimize the use of what? Unobservable inputs. And also one more important thing with regard to this fair valuation that you need to be aware, fair value hierarchy, right? So the fair value hierarchy is depending on the inputs that you use for the valuation techniques. You know, 2 types of inputs, observable inputs and unobservable inputs. 3 valuation techniques, market approach, income approach, and cost approach. Depending on the level of inputs that you used for the valuation technique, I can define fair value hierarchy. What do you mean by hierarchy? You have to go into order, which means when I want to fair value something, an asset or a liability, first of all, I need to look at whether level 1 inputs are available. What do you mean by level 1 inputs? 3 conditions. It has to be a quoted price for an identical asset in an active market. Quoted price means at any time you can look at the price. There are transactions happening then and there, right? So the price is available to everyone. Okay, price is available to everyone rather than, you know, transactions are happening regularly. Quoted price means that price is available. Price can be seen at any time. For identical asset, good example would be the investments that you do in the share market. Now let's say you acquired shares of a listed company. So with regard to your investments, with regard to your shares that you hold, you have quoted price for an identical asset. So the shares what is getting traded with regard to that company in the Colombo Stock Exchange are identical to the shares that you hold. Same company, identical assets in an active market. So there is what you call frequent transactions are happening. There are buyers and sellers. So the transactions are happening. You can verify. So highest quality inputs are what? Level 1 inputs, right? So the level 1 inputs can be used for the fair valuation without making any adjustments. Now, if you have 100 shares of a listed company, if you know the share price today, what you can do is take that price multiplied by 100 without any adjustments. You can say this is the fair value of my equity financial asset, right? That is level 1 inputs. Then level 2 inputs mean if you don't have the level 1 inputs, you first of all look at level 1 inputs. If you have it, use it. That is what is called hierarchy. While you having level 1, you can't go for the level 2 inputs. You go for the level 2 inputs if level 1 inputs are not available. So the level 2 inputs mean these are observable prices. It can be observed by the market participants, not only by the entity, but not level 1 inputs. They are not as good as level 1 inputs. Examples, quoted prices, active market, but similar asset, not identical. Here it's identical, similar asset, not exactly the same, similar asset. Or else it can be quoted prices for identical asset in less active market, not active market. It is what? Less active market. Market is less active. Okay, for you to say that level 1, it has to be quoted identical active. Here, not all 3 characteristics are met. Or else, as I mentioned earlier, those are observable input, but not the prices. Like, you know, to fair value unlisted company, you might use the price earning ratio of a listed company. Price earning ratio is an observable input. Okay, industry price earnings ratio is available, or else you are using market yield curve or the market yield data to value the bonds, right? Observable input, or else you are using an example where you can easily understand would be you are using recent market transaction prices of the property to measure property values. Because let's say if you have a property in a urban area, there are a lot of transactions happening with regard to similar properties, same location, similar condition. You have a lot of market transactions which have been taken place. Based on that, you measure this is the value of my property, because you have the per square meter price. You can observe, not only you, actually market participants can observe from the previous transactions. So those are observable inputs. Level 3 means lowest quality. You go for level 3 only if you don't have level 1 and level 2 both, right? Level 1 and level 2 both. So level 3 means unobservable. Market participants can't access. Only entity has this data. Example, let's say to value a business, entity prepare a cash forecast. So in the cash flow forecast, entity includes, this is my growth rate in revenue. These are my expenditure. This is the discounting factor I'm using, right? All these things are available only to the entity, not to the market participants, right? Those are unobservable. So you use your own data to derive the fair value. If you don't have level 1 and level 2 inputs, can't help. You have to go ahead with level 3 inputs, right? And also you should understand, if you need to, so the example, what I have explained is there in this particular slide, you all can go through. I'm not going to explain that. So the other thing what I want to mention is, if you make sometimes significant adjustment to the level 2 inputs. Now, I was telling earlier, you can use observable inputs that are not prices, like price earnings ratio of a listed company can be used to measure the share price of an unlisted company. Yield information or the yield curve information can be used to measure the bond prices. Then the market transactions of the property prices, recent transactions can be used to measure the property values. But if you make significant adjustment to these observable data, now these significant adjustments are sometimes unobservable by the market participants, then what will happen is, even though you use the observable inputs, as you are making adjustment to those inputs, so those adjustments are not observable by the market participants, it may fall into the level 3 category. Did you get my point? It is observable input, but you make the adjustments. These adjustments are not available for the market participants. So making a significant adjustment to an observable input can make that particular observable input also into the what? Level 3 input. So keep that thing also in mind. So again, I have done a past paper question, including all these things, right? So there's a good question in one of the past paper. So this concept of fair valuation was discussed or tested in detail under 4 scenarios. I have done that. So it's available in the LMS. Ensure you that you watch that particular video relevant to the question before you go to the examination, right? Okay, with that actually we completed with regard to the accounting standards. In addition to that, right, this particular company, this is information what is available in pre-scene yet again. Company is in the process of expansion, right? Because why? They are trying to, expand into foreign countries, overseas operation to be expanded. It is mentioned in the pre-scene. They are in the growth phase. Then they want to expand the local operation by appointing new distributors and opening up new retail shops, right? Then they want to move into this company getting listing stage, right? So it was mentioned that the institutional shareholder said that, okay, he wants to make this company a listed company, and chairman of the company agreed, right? So the Herat family, they agreed with that. Okay, they want to, streamline the supply chain. All these things actually lead company to move from the manual work to what? Automation, right? So for an example, they want to automate the field and factory operation. because it's not easy. Agriculture business means it's not easy. So their main business is growing herbs, the Ayurvedic medicine plants, convert them into, oil, medicine, right? So the healthcare products, and sell it to the market. So if the things are controlled manually, that's not easy. It's always better to have a automation system. Currently it is manual, and they are trying to implement a new ERP system. At the moment, what they use is accounting package ACPAC. So it's not integrated. So the modules are not integrated. Like if it's ERP, manufacturing, inventory, sales, everything is getting integrated. So we have good ERP systems at the moment, right? Like SAP, Oracle, right? In addition to that, in this particular accounting system, ACPAC, you have what you call access is given to certain users, which is not acceptable. They can do anything in the system, right? Then journal entries are posted manually. There can be errors. Okay. And also companies using, with regard to technology, it was mentioned that unlicensed software, right? So because of that, what they are trying to do is move into the automation. Then introducing of robotic process automation, like repetitive task to be done by robots, right? Rather than doing by people. Now, for an example, sales order entering into the system. Even the things like bank rec preparation up to a bank reconciliations up to a certain extent. So the repetitive task can be done by robots because robots are working 24 hours, not 8 to 5. And also they don't take any breaks, no tea break, no lunch break. They work continuously. So the efficiency can be improved. So with the expansion, so that is something it is important. So they are looking at that, and also using business intelligence, having enough or correct, solid information to make the decisions. Right. So actually robotic process automation and the business intelligence is an idea of CFO. Okay. So the Prasanna was he was recruited recently, and these are his ideas to go through this automation process. And also they are trying to do the business process re-engineering because especially with regard to the cost optimization, they want to rethink about the processes. Are there any ways to do this better by minimizing the cost? Because if you look at the financial statements, companies earning a good GP, right? GP margin is really good, but distribution cost is 27%. Administration cost is 11%. That two together 38% from the revenue. That would erode the operating profit or the operating profit margin of the company. So they have hired actually a consultant to do this cost optimization through the business process re-engineering. Right? All these things are important when you are answering to a question from the governance side, risk management side. So I'm not going to discuss these things in detail because Indunil will join later on to the session, and he will take you through what are the important areas in terms of these automation projects, as well as so the impact of these on the risk and governance side of the business. And also I have highlighted here, I have included here some of the points which are important yet again with regard to the risk and governance. So again, I'm not going to go into detail because Indunil will take you through the important areas. Like if you just look at in surface, compare doesn't have any independent directors. There are 3 directors, father and 2 children, right? So no independent directors. Then interest of the certain stakeholders have not been properly addressed, right? So you have different types of stakeholders like employees, community, then customers, suppliers. You can't just focus on the shareholders. You have to look at the other stakeholders. There's a concept called you have to have good governance in terms of all the stakeholders of an organization. So that particular point is also highlighted in the pre-scene. Then company has not held any annual general meetings, right? Then the board minutes are not maintained. There's no audit committee. So it's not a must actually at the moment to have audit committee because you are a private company, but soon you want to go for listing. So when you become a listed company, most of these things are mandatory requirements, right? Like independence of the board, then the audit committee, board meetings are to be maintained, annual general meeting to be held, right? So most of the things are must, but at the moment, even though it's a private company, you have to have AGM. So some people believe, okay, I'm a private company, no need to have AGM. No, nothing like that. But what I'm telling is this importance of these matters would be highlighted or aggregated once it becomes a listed company. Then CFO is not happy about certain accounting treatments. That means there are possibilities of risk of material misstatements, because accounting treatment would be incorrect. We'll look at this right in the second, what you call the second tutorial. Thereafter, no documented policies and procedures. So it's there in people's mind. So the policies and the procedures are not documented. Then no proper risk management system, lack of enterprise risk management system. So all these areas are important for the risk and governance. So not spending that much of time, because Indranil would take you through these areas later on at the day. Right. So that is with regard to this particular presentation. So the first presentation is done. So as I mentioned to you before, the most important thing today is not only to look at this, move into the next presentation that is about the consolidation. Right. Okay. So this is the current shareholding, right? So it's a family-owned company. Saman Herath is holding 40%, current chairman and MD. Ruan is holding 20%, son of Saman. Hansani has 20% in CAPL. So altogether, family holding is how much? 80%. This is the shareholder as at 31st March 2022. Okay, shareholding as at 31st March 2022. Right. Then there's an institutional shareholder called Blue Rock Capital, holds 20%, that was bought in a previously from Saman Herath. Okay, in the financial year 2021, Blue Rock Capital, institutional investor overseas, acquired 20% holding of CAPL. As per the pre-seen information, CAPL is planning to issue more shares to Blue Rock Capital, right, in future, probably in the next financial year. So that particular part would be analyzed in this pre-scene later on. But before moving to that, let's look at what are the possible consolidation scenarios that can happen that can be given in the unseen. Okay, right. Up to now, clear? No? So the first scenario, what can happen is CAPL can acquire a new company. That means this new company would become a what? Subsidiary to CAPL. Okay, so based on the information given in the pre-scene, what I believe is this time it would be a acquisition. Right, parent controls the subsidiary, so the parent, that is CAPL has to prepare the consolidated financial statements. Now, when it comes to this acquisition, acquisitions can be in different forms. We learned all these acquisitions: mid-year acquisition, step acquisition, foreign subsidiary acquisition. Right? If I rank as per my predictions, this time I give the first priority to step acquisition, second priority to the foreign subsidiary, third priority to mid-year. Why do I say that this is an acquisition this time? Because in the pre-scene, it was mentioned company want to expand their operations locally, overseas, right? So rather than acquiring assets by its own, the easiest way the company to expand is what? Buying an existing company, right? It may be in the similar operations where a company can get the synergetic benefits as well, right? So that's why I say that this is a acquisition this time, and also based on the other information given in the question, so it has to be an acquisition, right? So then let's look at these things in detail. What if it's a mid-year acquisition? What if it's a step acquisition? Or what if it's a foreign subsidiary acquisition? Mid-year acquisition, where the particular point what you need to understand is, if it's a mid-year acquisition, you have to consolidate the subsidiary from the date where the control is achieved. Especially mid-year acquisition is important when you are preparing the consolidated statement of profit and loss. Because let's assume if the subsidiary is acquired at the middle of the next financial year, you should consolidate the subsidiary only in the last 6 months. On the acquisition date, you need to calculate the goodwill. You have to start acquisition accounting, but when you are consolidating the subsidiary numbers, you have to time a portion, prorate the subsidiary income and the expenditure and add to the consolidated P&L. That's what you need to remember when it comes to the mid-year acquisitions, right? Okay. But for you to prepare the consolidated statement of profit and loss, examiner has to give you the next year P&L of the parent and next year P&L of the subsidiary both. So because of that, it's a bit unlikely, right? That's why I said that. That's why I have given the what least priority to the mid-year acquisitions. Are we clear? Any questions with regard to the mid-year acquisitions? Any questions with regard to the mid-year acquisitions? No. And if you, so with regard to the mid-year acquisitions, if you want to revise your knowledge, what you need to do is, so in the LMS recorded videos are available, right? Please look at the question number 3. Please look at the what? Question number 3. I'm talking about the consolidation module. Consolidation module. Question number 3 is with regard to a mid-year acquisition, right? Okay. Then the second scenario, most likely step acquisition. Step acquisition means investor obtain the control over an investee in stages. I have given a sample scenario here, example here. Let's assume our investor would be CAPL, right? CAPL is acquiring 40% of the new entity on 1st April 2022. That is the first day of the next financial year. Another 30% on 1st July 2022. So acquisition accounting should be applied from this date. So from this date only, you have to apply the acquisition accounting. What is acquisition accounting? Consolidation. Okay. So you have to consolidate the subsidiary from 1st July 2022. So why we say that this is a step acquisition? Because control is achieved in stages. Then so the question can be, right? If this is the scenario, the question can be, examiner can ask how the previous holding of 40%, okay, how the previous holding of 40% is to be accounted up until the consolidation process is done on 1st July 2022, right? How the previous holding is accounted until the acquisition accounting is applied on 1st July 2022. So then what you do? You have to decide what is this previous holding is. It can be an associate. It can be a joint venture. Okay, or else it can be a normal investment, financial asset. So you have to apply the applicable standard up until 1st July 2022. Now, in this case, if you have 40%, normally I can say that this is an associate. If it's an associate, what is the accounting? Equity accounting, LKS 28. LKS 28, accounting for associates and joint ventures. So you have to equity account up until 1st July 2022. If I take another scenario, let's say here on 1st April 2022, CAPL acquired 10%, and 1st July 2022, CAPL acquired 60%. In that case, this 10% holding should be accounted as per what? SLFRS 9. SLFRS 9, financial asset, equity financial asset, up until 1st July 2022, right? Are we clear? Then how do we account on the date where the control is achieved? On the date where the control is achieved, you need to calculate the goodwill, right? On the date where the control is achieved, you need to calculate the goodwill. When you calculate the goodwill, what you need to do is the previously held equity investment. In this case, it is 40%. If it is a normal financial asset, 10%, whatever it is, should be measured at the fair value on 1st July 2022, right? Either this 40% or this 10%, you need to measure it at fair value. If there are any fair value gains and the losses, now if you look at this scenario, associate scenario, associate is equity accounted. You have a equity accounted value on 1st July 2022. You compare that with the 40% fair value, or this 40% investment fair value on 1st July 2022. If there's any difference, you take that difference to the P&L. And to ensure that for the consolidation purpose, for the goodwill calculation purpose, this 40% is stated at fair value on 1st July 2022. Similarly, if it's equity financial asset, if your previous holding was 10%, what you need to do again, on 1st July 2022, this 10% needs to be measured at fair value. And the fair value changes, any change in the fair value, you need to take to the profit and loss of the particular financial year. That is 22-23 financial year, P&L should include this value gain or loss. But we know under SLFRS 9, you have two classifications. No? It can be FV TPL or it can be FV OCI. What I'm telling is, if this 10% was initially measured under FV OCI, that means it is measured at fair value and the fair value changes are taken to the other comprehensive income. So in that situation, when you fair value on 1st July 2022, this 10% holding, if it is measured under FVOCI, fair value changes are to be taken to the other comprehensive income, not to the P&L. Through other comprehensive income, it goes to equity reserve. Are we clear with that? If you apply the equity accounting, when you do the fair valuation on 1st July 2022, for this associate, fair value gains and the losses are taken to the P&L. If it's a normal financial asset, 10%. So if it is measured under FVTPL, again, you fair value the previously held 10% and the fair value gains and the losses are taken to the P&L. But if it is a normal financial asset designated as fair value through other comprehensive income, in that case, once you do a fair valuation, those fair value gains and the losses are taken to the OCI. Through that, it goes to the equity reserve. Are we clear with that? I hope it's clear. Right. So carefully read. These are very important, vitally important for the examination. So this is the highly probable scenario as well. Step acquisition occurs when parent company acquire the control over the subsidiary in stages. This is achieved by buying blocks of shares at different times. Acquisition accounting is only applied at the date where the control is achieved. In this example, you apply the acquisition accounting only when, that means consolidation accounting only when 1st July 2022. As mentioned earlier, before applying the acquisition accounting, previously held equity investments, you need to measure as per the relevant standard. If it's a normal investment under SLFRS 9, FVTPL or FVOCI. If it's an associate or a joint venture, you need to apply LKS 28, equity accounting. If it's a joint operation, if it's a joint arrangement other than a joint venture, that means joint arrangement other than a joint venture means if it's a joint operation, it has to be measured under SLFRS level. Apply the particular standard for the pre-existing shareholding. Then once the equity interest is increased and the control is achieved, in my example, 1st July 2022, what we need to do is remeasure the previously held equity interest at fair value, recognize any resulting gain or loss for the year. That means any gain or loss because of the fair valuation of the previously held equity interest, you need to take that to the P&L, but into the other comprehensive income, if the shares had been designated and measured at fair value through OCI. If it was measured under fair value through OCI, in that case, fair value gain or loss to be taken to the OCI. Through that, it goes to the equity reserve. Then on the date where the control is achieved, you need to calculate the goodwill and you need to measure the value of the non-controlling interest. Are we clear with that? Are we clear with that? Any questions? Any questions? No. Then one more thing that you need to remember, if I go back, especially with this FVOCI, this particular point, what I'm going to tell you is applicable if you measure the previously held equity interest under FEOCI. You are measuring under FEOCI means, right, on this date where you start applying the acquisition accounting, you have an equity reserve, right? You have an equity reserve. What is equity reserve? Accumulated gains, accumulated unrealized gains and losses, measuring this financial asset at fair value. You have a accumulated gain or a loss in the equity reserve. Now, at the point where you achieve the control, this equity financial asset would become an investment in subsidiary. In the consolidated financial statements on the consolidated balance sheet, this investment, earlier it was a financial asset, normal financial asset, now it would become an investment in subsidiary, which means I have to de-recognize the particular equity financial asset, because since this point, there's no normal financial asset under SLFRS 9. So you need to de-recognize. At the time of de-recognizing this particular equity financial asset measured at fairly through other comprehensive income, this accumulated value in the equity reserve, what you do, you transfer to the retained earnings. Don't keep that in the equity reserve, you transfer that to the retained earnings. So that is applicable only if this particular previously held equity interest is measured as a normal financial asset under SLFRS 9. It is designated as fair value through other comprehensive income measurement. I hope yet again you understood that particular matter. Right. Okay, step equations we discussed. Any questions with regard to step equations? Now we discussed about the mid-year equations, we discussed about the step acquisitions. Right, before moving to the foreign subsidiary, I'll tell you with regard to step equations, what you need to do. If you look at the LMS, right, listen this carefully again. If you look at the LMS, you have a video. First video in the exam preparation module or the revision module is the pilot paper at the time of introducing this paper, SL1. So there, the consolidation question is a step acquisition. Previously, it was associate. Later on, it has become a subsidiary. Right? That is the first question that you need to relook at. Then I have done the past paper, July 2021 paper, past paper question, that also a step acquisition. Again, previously an associate, later on it become a subsidiary. So these are the two questions, pilot paper question uploaded into the LMS and the past paper question, which I discussed in one of the live interactive session, which is there in the revision module. So you can watch these two videos with regard to the step equation. In addition to that, if you really want to know the theory, question number 4 and 5 of the consolidation module. So the entire consolidation module I have uploaded into the theory. Anyway, it's there in the theory class, as well as I have uploaded into the revision module as well. Question number 4 and 5. Question number 4 actually equity financial asset under SLFRS 9, then it has become a subsidiary. Then the question number 5, associate has become a subsidiary. So these are the relevant videos with regard to the revision and the theory modules that you need to refer with regard to the step acquisition, right? Okay, 1 second. Okay, so there's a question, if only the revision mode, you have the access to the revision module. Yes, that's why I mentioned that if you have the access to the revision module has past paper questions, pilot paper, as well as all the theory videos relevant to the consolidation is also uploaded into the revision module as well, right? So you can refer, or else now I will tell, because what is the most important is getting through the examination. I will tell admin staff, right, Infinity admin staff, if anybody who is having the access to the theory module to give the access, sorry, anybody who is having the access to the revision module to give the access to the theory module as well, right? So you'll be giving the full access, I'll inform them, but you have to call them and get it sorted. So the point is, if you have the access to the revision module, get the access to the theory module as well. Doesn't matter. Okay, if you don't have the access to both, okay, so I will tell admin staff, if you want, what you can do is you contact them, right? So they'll give you whatever the access that you want during this time, right? As I mentioned, you just have only 1 week. You don't have time to, go here and there to study, look at these notes. So anyone who wants the access during up until the examination, call admin people and get it. I will instruct them, right? So otherwise it's difficult for you to find out, okay, where these videos are there and all that, right? Fine. Okay, right, moving on. Then about that's a gift, right? Utilize it properly. Okay, utilize it properly. Yeah, you have to ensure that you get to the examination, right? Okay, I don't want to see you again in an SL1 class, right? Next time, ensure that this is the time you get to, right? Okay, moving on. So the third scenario can be under the acquisitions. It can be a foreign subsidiary acquisition, right? Foreign subsidiary acquisition, which means here parent company, that is CAPL, is acquiring a foreign subsidiary, because under the pre-scene it was mentioned that company wants to expand overseas, right? One of the way where you can do the aggressive expansion is acquiring a foreign subsidiary to manufacture the products that you want, right? Then you have the local knowledge in the foreign subsidiary or the foreign company or the foreign country to carry out the marketing and selling activities as well, rather than you carry out the operations by being in Sri Lanka. So whatever the good foreign markets you identified in a particular country, if you have a subsidiary, that would be easy, right? So if it's a foreign subsidiary, you should know how to consolidate the foreign subsidiary with the parent company, that is CAPL. So you should know the conversion rules, because different items in the foreign subsidiary are getting converted at different rates, because you can't add the parent's numbers, that is in rupees, and the subsidiary numbers in different currency. You have to convert the subsidiary numbers into parent's currency before doing the consolidation, right? So when you are doing the conversion, income, expenditure, and the other comprehensive income of the subsidiary company's financial statements to be converted at the exchange rate at the rate of the transaction. But in the examination, we can't take the exchange rate at the rate of the transaction, so that as an approximation in the exam, P&L items and the OCI items, income, expenditure, and the other comprehensive income is getting converted at the average rate. Okay. Then the assets and the liabilities of the foreign subsidiary are getting converted at the closing rate. Okay. In addition to that, if the share capital, in addition to that, share capital and pre-acquisition reserves reserve is converted at historical rate. What do you mean by historical rate? Exchange rate at the rate of acquisition. Right? These are the conversion rules. Then the post-acquisition reserve actually includes the exchange difference. Okay, post-acquisition reserve. So the exchange difference is a post-acquisition item. Now, what I'm telling is, obviously, once different items are converted at different rates, there'll be what? Exchange gains and the losses. This is considered as exchange difference, where you should include the exchange differences when you are preparing the consolidated statement of profit and loss and OCI. Translation gains and the losses of a foreign subsidiary has to be included in the other comprehensive income. One of the item in the other comprehensive income is the translation exchange gains and the losses of the foreign subsidiary. Okay, so these translation gains and the losses arise mainly due to two things. One is, as I mentioned, assets, liabilities, which means net assets, and the profit, income, expenditure, profit is getting converted at different rates. On the other hand, one more reason of deriving exchange difference, that is because of the goodwill. Goodwill calculation is a very important adjustment in consolidation. When you have a foreign subsidiary, goodwill calculation is special. Why do I say so? Now let's say parent's currency is rupees, CAPL's currency is rupees. You acquire a subsidiary. Okay, you acquire a subsidiary. Let's say you acquire a subsidiary in a different country. Let's say in US, right? Subsidiaries in US. So the subsidiary's currency is what? Dollars. Okay, hypothetical situation, right? Sri Lankan parent and subsidiaries in US. Now what you do is when you are calculating the goodwill of the foreign subsidiary, you have to calculate by using the functional currency of the subsidiary. That means in my example, you have to calculate the goodwill in dollars. Now, CAPL and foreign subsidiary. Okay. Now CAPL's currency is LKR. That's Sri Lankan company. Let's say this is US company. So their currency is dollars. Now, when this acquisition has been taken place, let's say it's a 80% acquisition. There's a shareholder in the foreign country as well. So in this situation, what you do is, so the functional currency of the subsidiary, foreign subsidiary is dollars. As I mentioned earlier, subsidiary numbers, income, expenditure, other comprehensive income, assets, liabilities, share capital, pre-acquisition reserves to be converted by using different exchange rates. In addition to that, when calculating the goodwill, when calculating the what? Goodwill, you have to do the calculation in dollars, not in rupees. You have to do the computation in dollars. So the goodwill should be calculated by using the functional currency of the subsidiary. Then, like any other asset or the liability, now once goodwill is calculated, this goodwill is an asset of the foreign subsidiary, right? Goodwill is a asset of the foreign operation. Like any other asset or a liability, then this particular goodwill figure also getting converted into LKR, into parent's currency by using the closing rate each year. Because earlier I mentioned to you assets, liabilities of the foreign subsidiary to be converted at the closing rate. So once you calculate the goodwill in dollars, this dollar figure to be converted into LKR every year end by using the closing rate. That would also amount into what? Exchange differences, exchange gains and the losses. Those exchange gains and the losses are also included into the other comprehensive income, right? So there are two types of exchange gains and the losses. One is exchange gains and the losses because of the conversion of net assets and profits of the foreign subsidiary. The other one is exchange difference because of the conversion of the goodwill by using the closing rate, because goodwill is calculated in the foreign currency. Are we clear with that? So process of translating the overseas subsidiary gives rise to exchange gains and the losses, exchange gains and the losses, right? So current year exchange gains and the losses. So the current year exchange gains and the losses of the overseas subsidiary and goodwill are recorded in the other comprehensive income. Are we clear up to now? Then now, for an example, let's say if you look at the P&L, what you have is current year income and the expenditure. If you look at the other comprehensive income, what you have is the current year other comprehensive income. When it comes to the other comprehensive income, then what you have is with regard to the foreign subsidiary current year exchange gain or loss. Then this exchange gain or loss each year is getting accumulated in an equity reserve called what? Translation reserve. Now you have the current year gains and the losses, exchange gains and the losses in the other comprehensive income. Out of that, accumulated exchange gain or loss relevant to the parent company. Because here, what I mentioned was what is the parent's acquisition of subsidiary 80%. Now, once you derive the exchange gains and the losses out of this conversion, 80%, that is parents component of the exchange gains and the losses, are getting accumulated in an equity reserve called what? Translation reserve. Then where do we have the NCI, that is 20%, because parent is having 80% means NCI is having how much? 20%. Where do we have the 20% of the exchange gains and the losses? That is included within the NCI account itself. Okay, when you are preparing the balance sheet, consolidated balance sheet, you have a, when you have a foreign subsidiary, you have a reserve called what? Translation reserve. What do you have in the translation reserve? Accumulated value, total value of the exchange differences belongs to the parent. Exchange differences belongs to the subsidiary. So exchange differences belonging to the non-controlling interest. 20% shareholders of the subsidiary are included in the NCI balance itself. So you have NCI balance now. Within that, NCI amount of the exchange gains and the losses are included, right? This is in very brief, right? I haven't done a full question, but I wanted to explain you the important stuff. Exchange gains and the losses arising from translation of goodwill and subsidiaries opening net asset and profit, which are attributable to the group. Group means parent company. In this particular matter, parent's acquisition in subsidiaries 80% are normally held in a translation reserve that is a separate component within equity. Are we clear with that? Are we okay with that? I hope you understood. That's about the foreign subsidiary. Now, if it's a foreign subsidiary acquisition, now looking at this particular matter now, if I go back to our question, now let's say our company is CAPL. If it's a foreign subsidiary, what can happen is examiner can say that on the next day of the following financial year. So the new financial year starts from 1st April 2022. 22-23 financial year starts from 1st April 2022. Examiner can say that, okay, CAPL has acquired a foreign subsidiary on 1st April 2022. These are the information. These are the financial statement numbers. So then you have to do the consolidation accordingly. It can be a full question. It can be full question means you are requested to prepare the entire balance sheet sometimes, right? If it is on the very first day, if parent acquire the subsidiary, then you have to do the conversion by using the exchange rate on the very first day at the date of acquisition, right? Normally, I explain to you how to prepare the consolidated financial statements at the year end. But let's say if examiner wants you to prepare the opening consolidated balance sheet that the parent company has to prepare, including the foreign subsidiary. So you have to take, you don't have the numbers at the end of the year. You just been given the numbers of the foreign subsidiary at the date of acquisition. Then you have to do the consolidation accordingly by taking the exchange rate at the date of acquisition. Is that clear with you? Again, it can be a full question to prepare the entire balance sheet, or else examiner can ask theory parts with certain computations like goodwill computation of the foreign subsidiary. Because why? Goodwill has to be calculated by using the foreign currency or the functional currency of the subsidiary. In my example, dollars. Then examiner can test you the computation of exchange gain or loss. We know there are two reasons why the exchange gain or loss arise. One is net asset and profit conversion. The other one is conversion of goodwill calculated in the foreign currency at the end of each reporting date. Examiner can test on that as well. So the recent trend, as I mentioned earlier, testing computations with relevant theory explanations. So you should be ready to explain what you do. You need to compute and you should explain with the logic, why do you do these computations? Why do you do these things? Okay, why? So because you can explain goodwill is a asset of the foreign operation, so that you compute the goodwill in foreign currency. Then thereafter it has to be converted by using the closing rate at the end of each year. Okay. Okay, so there's a question. So this is going into detail, but as the question was asked, I'll explain. When there's an exchange difference on goodwill, where you should allocate that exchange difference? Should we allocate to both parent and non-controlling interest, or else should we allocate only to the parent? What is the answer? It is depending on the goodwill calculation method. If the goodwill is calculated by using the fair value basis of measuring the NCI, within the goodwill, you have the full goodwill. If the NCI is measured by using the fair value method, within the goodwill figure, you have both parents and NCI goodwill. In that case, if you have any exchange gain or loss on goodwill retranslation, that exchange gain or loss to be allocated to parent and NCI. In my example, 80% to the parent and 20% to the NCI. 80% to the group, 20% to the NCI. But if the goodwill is calculated by using the proportionate net asset basis, that is NCI was measured at proportionate net asset basis, within goodwill figure, what you have is only parents goodwill, acquirers goodwill. In that case, if you have any exchange gain or loss, that entire exchange gain or loss to be allocated to the group, right? No allocation to the NCI. That is the answer to this question. Going into one step ahead, but I told you there's another reason why the exchange gains and the losses arise. That is because of the conversion of net asset and profit. When it comes to the exchange differences, exchange gains and the losses out of the conversion of net assets and the profit, so those exchange gains and the losses always you allocate to the parent and NCI, always 80%, 20%, right? Because net asset and profit is belongs to both parent and NCI. So the exchange differences allocate to 80% to the parent and 20% to NCI in my example, if it is a 80% acquisition. Are we clear? I hope you are clear about it. Okay. Explain. Right. So the areas what you need to refer with regard to the foreign subsidiaries are, I have included 4 model paper questions in terms of the consolidation, right? In addition to the past papers, all past papers of the new syllabus, plus the pilot paper, I have separately done 4 videos, 4 exam type questions, right? I would consider these as mock exam questions. Out of that, if you look at the 4th question, okay, if you look at the 4th question, that is a consolidation of foreign subsidiary. Because this consolidation of foreign subsidiary has not been tested for a while. It has not been tested for a while, so there's no past paper question, but there's a model paper question, question number 4. It's an exam type question. Look at that. In the theory videos, question number 15 and question number 17, question number 15 and question number 17 with regard to consolidation are relevant to the foreign subsidiary consolidations, right? Okay. Okay. Then I want to highlight one more important aspect with regard to the information given in the pre-scene. Okay, that is involvement of Blue Rock Capital, overseas institutional investors' involvement in this situation. Okay. This is the existing or current shareholding structure of the company, CAPL. Someone is holding 40%, Ruan 20%, Hansini 20%, altogether family ownership is 80%, and institutional investor is holding 20%. So the total number of shares issued 8 million. So as per the question, per share price is 1250, which means the total value is 100 million. And in the pre-scene, it was clearly mentioned CAPL is going to issue shares to the institutional shareholder, that is Blue Rock, right? Blue Rock, more shares. So once more shares have been issued, one is CAPL receive cash. So that's why I said that there is another reason why CAPL will go for an acquisition this year, because to do an acquisition, you need to have resources, no? You need to have cash, no? So CAPL is going to issue new shares to the institutional investor. So out of that, CAPL receive cash. By using that cash, they can do the acquisition. What I have mentioned earlier, it can be a step acquisition, it can be a mid-year acquisition, it can be a foreign subsidiary acquisition. That part we have already discussed. On the other hand, I don't know whether you have noticed or not, you have been given the projected financial statements of this company, CAPL. According to the projected financial statements from the next year onwards, you have been given the next 5 years, if I'm not mistaken. If you look at the stated capital of the projected financial statements of CAPL, how much is the value? So is it, have you looked at that? Can you remember how much is the value as per the projected financial statement, stated capital? Have you noticed that? It is 125 million, 125 million. What would have been that? What would have been the reason? What would be the reason? What they are going to do? They are going to issue shares to whom? BlueRock, worth of 25 million, right, in the next financial year. So once they do that, percentage ownership of the institutional shareholder will go up, and the family shareholding, all these shareholders, so their shareholding will get diluted. So what can happen is, this is what it can happen. So CAPL issue, the value has to be 25 million. No? Value has to be 25 million. So per share price is 1250. So to have it 25 million, how many new shares that the company has to issue to the institutional shareholder? If it is issued at the same price, 1250, 2 million shares. So once 2 million shares have been issued to BlueRock, so at the moment, BlueRock is having 1.6 million shares plus 2 million shares, altogether 3.6 million shares. But the shareholding or the shares that is held by the other shareholders are not going to be changed. But overall now, company has issued 8 million here, 2 million new shares, company has issued 10 million shares. This would be the possible scenario, right? Then what would be the stated capital after this share issue? 100 million here, 25 million here, 125 million. And the most important thing is, what is the ownership structure now? What is the ownership structure now? Saman, current chairman and MD, 3.2 million out of 10 million shares, 32%. Ruan and Hansani, 1.6 million each out of 10 million, 16% each. And the percentage ownership of BlueRock is getting increased to 20% to 36%. And remember, at the moment, when BlueRock is holding 20%, they don't have, even though it is 20%, they don't have a board position at the moment, right? Normally, we believe that, okay, if an investor is having 20% to 50% ownership of another investee, that investor can consider that investee as an associate. You have the significant influence. But according to this question, based on the information given in the pre-seen, in the unseen, examiner might say that even though you have 20%, you don't have the significant influence because you don't have a board position, right? So that means the previous holding that BlueRock is having in CAPL should be accounted as a equity financial asset under FVTPL or FVOCI. We discussed about that. Fair value through profit and loss or fair value through OCI. But once this change has occurred, what would happen is, on one side, shareholding of BlueRock Capital increases to 36%. And also in the pre-scene, it was clearly mentioned they are asking, that means BlueRock Capital is asking 2 board positions, right? That means at the moment, 3 directors, Saman, Ruan, and Hansani are the directors. 3 directors, only 3 directors. If the request of BlueRock Capital is considered, and if they are given 2 board positions, what will happen? Then the number of directors of the company would be 5. Out of that, 2 board positions are given to BlueRock. Definitely, they can have a significant influence over the CAPL's operation. So for BlueRock, it can be a what? Associate. For the BlueRock Capital, CAPL would become an associate. Are we clear? Because this would be the shareholding. Saman 32%, Ruan 16%, Hansani 16%, BlueRock is having 36%. So the BlueRock would become the investor and CAPL would become the what? Associate. Might not be a full question, part of the question, a computation and a theory can be tested on this. Examiner would give you the indication to suggest that BlueRock is having the significant influence over CAPL. Okay. Or else, if examiner wants to go or need to be a bit creative, what he can say is, he can give information where BlueRock and someone make decisions about CAPL with unanimous consent. He won't directly tell you it's unanimous consent and all that, but he would give you indications. So after this share acquisition has been happened by BlueRock, the decisions about the relevant activities, that is main activities, like marketing related aspects, sales related aspects, and operational things like what products to manufacture, which market the product is to be sold. These decisions are made by someone and BlueRock with unanimous consent. So what does that mean? In that case, both Saman and BlueRock would become the joint venturers of this joint venture. So it can be a JV as well by Saman and BlueRock. So you can't make decisions alone. Whatever the important decisions with regard to CAPL to be made with the unanimous consent. So yet again, if it's a JV even, accounting is not going to be different, right? If it is an associate, you have to apply equity accounting. Even if it's a JV, so this is LKS 28. If it's a JV, there even either BlueRock Capital or someone has to account this under equity accounting. Actually, it is from the point of view of BlueRock, if the financial statements are to be prepared, because Haman is an individual, BlueRock is a company. So in the financial statements of BlueRock Capital, so the CAPL has to be accounted either as associate or a joint venture. In both cases, what is applicable is LKS 28, accounting for associates and the joint venture equity accounting. Is that clear with you? Because it's unlikely, unless otherwise examiner want to put a U-turn, it's unlikely where BlueRock is given the control over CAPL. Two reasons. One is this is a family-owned business, right? So family doesn't want to lose the control. There are no negative aspects, what is mentioned in the pre-scene, for the family to lose the control over the business. So maximum what the family would consider is kind of a significant influence over CAPL. Maximum would be a joint venture. So because of that, it is unlikely where BlueRock to acquire the control over CAPL. That is one reason. That's why CAPL is not a subsidiary. On the other hand, if it is a subsidiary and if you are given to prepare the consolidated financial statements, then what will happen is BlueRock is a foreign company. In my example, I told you, let's assume, BlueRock is a foreign party, right? Let's say BlueRock is a institutional investor. So their functional currency is pounds. What is the currency? Pounds. It's a UK based company, pounds. So the functional currency of CAPL is LKR. Now, if you want to prepare the consolidated financial statements, subsidiary has to convert, that is CAPL has to convert LKR denominated figures into pounds. Within that, in our paper, CS Sri Lanka paper, you are given a consolidation which has to be denominated in pounds. That's why I said that it's a bit unlikely to ask a full question with regard to the consolidation of CAPL by BlueRock, where the BlueRock would become the parent and CAPL would become the subsidiary. Okay, but if it is tested, you know what is the accounting treatment of subsidiary, because we discussed the acquisitions in detail, right? We discussed about the mid-year acquisitions, we discussed about the step acquisitions, we discussed about the foreign subsidiary acquisition as well. Okay, right. So these are the possible areas with regard to the consolidation. I told you LKS 28 is applicable for the accounting for the associates and the JVs. Both associates and the JVs are equity accounted. Equity accounting means cost plus share of post-acquisition net asset increase. Cost plus share of post-acquisition net asset increase. So associate means an investment over which investor has the significant influence. So the significant influence means power to participate. but not to control the relevant activities of the entity. What is relevant activities? Activities which significantly affect the investee's return. Things like what products to manufacture, which markets the product to be sold, capital structure, marketing and sales decisions. These are the relevant activities. So if a particular investor can significantly influence or power to participate the relevant activities of an investee, you consider that as an associate and apply the equity accounting. Okay. On the other hand, I explained about the joint ventures as well. A joint venture means two or more parties have the joint control over a separate entity. In this situation, what can have is Saman Herath and Blue Rock Capital can have the joint control over CAPL. So the decisions about the relevant activities of CAPL are made with unanimous consent. Okay. All right. Then, any questions up to now, students? Okay, so there's a question whether this video will also be uploaded into YouTube. Yes, I will do, right? Even though you don't have the access to LMS, doesn't matter. Like I have done, I'll instruct admin staff to upload this also into YouTube. Anybody can watch even though you don't have the LMS access. And as I mentioned earlier, so if anybody wants to have the LMS access, contact administration staff. So up until the examination, you can have the access to theory as well as the revision video at any time, right? So I'll instruct accordingly, because the things what I have mentioned, the questions what I mentioned, you need to you need to attempt before you go to the examination, right? That I will do. Foreign subsidiary question is available. So two questions are available. Question number 15 and question number 17 are available in the theory module, and the one mock paper question, that is model question, is available in the revision module. Okay, right. Then finally, what I want to mention you is about the statement made by CFO. He's a chartered accountant, Prasanna Pereira, appointed recently, and he has mentioned that certain accounting treatments are adopted by the company are not correct. After joining the company last year, he has voiced this concern to someone, that is to chairman and MD at the moment, regarding the manner in which certain transactions are recognized in the financial statements, as he feels that they do not conform to SLFRSs and LKSs. So obviously what will happen is there's a risk of material misstatement. This is the connection between the financial reporting and the risk and governance aspect of the, because you remember that most of you are focusing only on the financial reporting in this paper, but remember 45% of the marks are allocated to the ethics, risk and governance, right? So the risk of material misstatement can be there from any area of the, from any area of the accounting standards what I have discussed throughout these two sessions. I have done the first session on 13th of July, and I have done the second session today. So the risk of material misstatement can be related to any accounting standard related matter, what I have discussed earlier. It can be with regard to the, for an example, let's say agriculture standard. So classification of bearer plants and consumer plants, right? Then the cost capitalization of the development center. You have not correctly capitalized the cost related to the development of the research and development center. It can be with regard to the borrowing cost capitalization. It can be from any area, from the things what I've discussed. In addition to that, I will show you now, right? So within the given financial statements itself, you can identify there are certain misstatements, right? Let me go there and show you. Let me open up the let me open up and share the what I call pre-scene, where I will highlight what are the risk of material misstatements are. Okay, so this is the pre-scene where you know, like all this highlighted stuff I have discussed with you. Okay, Now you should tell me, right? You should speak. I highlighted, tell me the issue here. 151 million in the unaudited financial statements of 21-22 research and development expenditure. What is the problem here? What is the problem here? Hurry up, guys. What is the problem here? Can you explain the development cost, research cost? Again, I'm not going to discuss the theory. I have already discussed right in the previous session. Research cost you need to expense to the P&L, charge to the P&L. But are you charging the development cost in the P&L? Normally, development cost is capitalized, subject to 6 recognition criteria. Normally, development costs are capitalized. You don't expense to the P&L. But this entity might have been expensed the development cost to the P&L. Right? That is understatement of profit. Right? Profit is getting reduced. Unless otherwise you are a SME. If it's a SME, this company is not a SME by looking at the revenue figure, asset figure, because it's clearly mentioned that if the revenue is more than 500 million, then the asset base is more than 300 million, equity is more than 100 million, liabilities to the banks and the financial institutions more than 100 million. You can't consider this as you can't apply the SME standard. So this is full SLFRSS. So they are the development cost you can't charge to the P&L. Then one more point I want to mention. Now, if you look at the finance income of this company, right, you have the finance income only in the last year. What about the previous years? But if you look at the balance sheet, you have the financial assets throughout here, and the value of the financial assets have not been changed. But CFO is mentioning that they have some equity investments. Where do they classify these equity investments? So the financial assets can be found out here as well. You can find out here as well, financial assets, right? But the values are not getting significantly changed. So if it is an equity financial asset, you need to measure it at fair value, either fair value through profit and loss, or else you need to designate that under fair value through OCI. It has not been done, it seems. And how can you have the finance income only in the last year? What about the previous years? Haven't you take them into consideration? There's a risk of material misstatement, right? What else? What else? Then, if you look at, I'm just highlighting the important aspects, right? Then you have a revaluation gain here, again only in the current year, right? Normally what we do is, if you are following the revaluation model for the PP&E, you have to do that with sufficient regularity to avoid a material difference between the carrying value and the fair value of the asset. Okay, if you follow the revaluation model, the asset value on the balance sheet, the carrying value should not be significantly different from the fair value. Might be this particular company believe that if you do the revaluation maybe once in every 3 years, that's fine, because it doesn't mention that annual revaluation is to be done. It's not mentioned. What the standard says is, if you follow the revaluation model, there shouldn't be a material difference, significant difference between the carrying value and the fair value of the asset. Okay, so on that basis, they might have done the revaluation once in every 3 years, then it would be okay. But there can be a question mark on that. Why do they do revaluation only in this year? What about the previous 2 years? And on revaluation, there's a deferred tax impact. That's correct, no? Once you revalue the asset, carrying value of the asset goes up, tax base won't change. If the carrying value of the asset is going up, comparing with the tax base, that will amount into deferred tax liabilities. And this particular deferred tax liability based on the revaluation is recognized in the other comprehensive income. That is also correct, because revaluation gain is recognized in the other comprehensive income, relevant deferred tax liability also to be recognized in the other comprehensive income. That is correct, right? But my question is, now with this revaluation, you recognize a deferred tax liability. The double entry would be credit deferred tax liability 28, debit 28 to the other comprehensive income. Debit 28 to OCI, credit 28 to deferred tax liability. In that case, if you go and look at the deferred tax liability value, actually deferred tax liability value should go up, right? because you recognize a new deferred tax liability because of the revaluation gain. But if you look at the deferred tax liability value in the balance sheet, it has come down. The reason would be there should be a material deferred tax asset that should have been recognized in the current year. What is it? Or else there should be a significant reversal of an existing deferred tax liability. What is it? Is that correct? Have they done the deferred tax computation correctly? Okay. Here the revaluation reserve, if you look at last 2 years constant because no revaluation, but this year it has gone up by 73. That is correct because of the revaluation gain of 101, revaluation reserve credit, asset debit. Because of the deferred tax impact, revaluation reserve debit, asset. Sorry, because of the deferred tax impact, deferred tax liability credit, debit, OCI. So the net impact would be 73. So that net impact is reflected in the increase in the revaluation reserve. That particular treatment is correct. But there are a lot of question marks. Why the deferred tax liability has gone down when there's a significant deferred tax liability created with the revaluation? Okay. So these are actually some possible areas where there can be risk of material misstatements, right? Right. So as I mentioned earlier at the very beginning of the session, right? So that's it with what I need to cover with regard to the financial reporting aspect. But as I mentioned at the very beginning, we have here Indunilsa, right? He's doing the risk and material misstatement part. And as he was there in the session.
So I think congratulations, Dasun. I was listening to part of your lecture. So well articulated, lot of possible exam questions, and you have made my life also easier, giving a very good analysis of how financial reporting issues can be connected to risk of misstatement. There is only addition to be done to that to convert it into auditing language using the right terminology. So that is what makes the difference, right? That's how you can not just pass the exam, even you can be a prize winner if you break into this. Meaning, if you go beyond consolidation and accounting standard and get into the art of getting the full mark from this section, you are going to be the prize winner. So with that, I am not going to now do a detailed detailed discussion. As you know, I have also published a mock paper which is based on your pre-scene for 60 marks. While it is 45, I just added some additional question covering governance, risk of misstatement, ethics, like exam questions. So you can take the time, set the time, do the paper. So I'm arranging a separate discussion to cover that. But in relation to Dasun, is there any slide that you have?
Sure. So yes,
will you be able to share them? Just to connect to what Dasun has been talking, so that you in this session you get the full picture, and then I will subsequently discuss the answer for the mock paper. Also make this opportunity to ask any question, because you don't need to wait for another session. Now every minute is important. You can ask any question right now.
Sorry, not this. 1 second, please.
Yeah, so mock paper, in a little while, I asked actually our staff to make it available for students. So you will get that very soon. It is already there in the LMS, but we'll make it available for all the students.
So actually in the deal here, so the company is in the process of automation with their expansion plans. I believe that with this system changes, especially with the introduction of this new ERP system to integrate the things, and like things are getting automated, this can lead to a question with regard to your area.
Yeah, so definitely that's a valid observation. Dasun, see, the idea is that, you know, if you look at the financial reporting process, what governs financial reporting process is the internal control. So internal control has 5 components. Now this is only sharp students will know what I am talking. So the 5 components of internal control, one component is what produces financial statement, that is information system. So information system is a very often, it can be a ERP, it can be a standalone accounting package. So even in the last paper, examiner was so interested in this area. You can look at the paper. This same integration, that there was a stock module not integrated, all that story was there in the last paper. In this paper, again, examiner is coming up with this information to say that there is a manual system, new ERP is coming, there is a RPA. For example, RPA is not a magic, it is already there in Sri Lanka, most companies practice, but what are the internal control implication of RPA, right? So this area, this slide can be connected to a very specific learning outcome called IFR, internal financial control, or internal control over financial reporting, more specifically information system, further specifically about controls over journal entry. And then that connects to fraud risk. So like that, there are wider connections you can make and predict questions and prepare for those questions. Nothing wrong. It may come in the pre-scene, may not come. It may come in some other question. As you know, there is separate question can come uh, to test this learning outcome. Therefore, this pre-scene enables you to practice almost all the learning outcomes of the entire syllabus. So, but examiner may choose to select some areas only for 50 marks question. So this is correct, Dasun. So this slide can be connected to especially internal control over financial reporting in the context of information system.
Yeah, I think you got a very good answer for that. So, and also I have highlighted again, there are some matters relating to
Yes,
the governance and risk. So these,
correct.
especially once the company is going to get listed, so these things would be mandatory. Some of the requirements like have a good audit or audit committee. So if you can brief this as well,
Yeah,
that would be good for the
correct.
students.
Yeah, excellent. Again, this is categorically, this examiner, we can probably see examiner's mind. Examiner has more interest on this subject. That is why in this pre-scene, there is a whole lot of information connected to governance, risk management, internal controls. So this section in the pre-scene is very clear to say that they don't have independent directors. Don't expect very childhood question being at the final stage. You need to have a mature knowledge in corporate governance, right? Examiner might ask, now the pre-scene says there are 2 directors to be appointed, and that currently CEO and chairman is one. You may be asked to evaluate the risk of that board structure. So like that, some students, they have a set mind. Okay, they think that they can memorize, open book is there to write corporate governance. You can't, right? You need to really practically apply the concepts, right? Now, in this case, one question examiner may ask, right? What is the benefit of bringing non-executives? What is the benefit of bringing outside directors? If those questions come, most of the students get stuck, right? So therefore, what I suggest is that you need to again link these questions to various information. For example, one examiner may ask, right? Propose, you are a consultant for this company, propose recommendation to strengthen the current board. Then what are your main recommendations? Obviously, you might say add non-executive, but what type of non-executive? How about the board diversity? Did you look at the qualification experience of the existing directors, the family members? Considering the business model, the fact that they are operating in overseas market, for example, that they might be benefited by having a foreigner, right? So that's how women on board, is it adequate? All these are hot topics in governance. I'm talking about the first bullet point. So similarly, second bullet point is very, you will see in my mock paper also, one of the question you might, there's a greater chance of asking this question, right? Evaluate the current perspective to corporate governance, right? And with a particular reference to stakeholder approach to governance, right? So there are 5 perspectives of corporate governance. For example, the shareholder perspective, stakeholder perspective, financial economics perspective, social perspective. Likewise, now this case study specifically talks about stakeholder perspective, and many stakeholder issues have been given in the question. For example, the villagers are not happy, employees are not happy, right? And that the environmental authority is going to sue or going to stop, cancel, suspend the license. All these are ESG issues. So another hot topic that will come in your paper is ESG stakeholder perspective. So definitely there is a greater chance, more than 50% chance, that this second topic as well as ESG to come. So the AGM, obviously, others are obvious governance weaknesses. If the examiner asks a basic question, what are the governance weaknesses? The board minutes not there, AGM not here, those you can talk. And given that they have many financial reporting issues, especially when the CFO has some ethical issues, all of these contexts, that there is definitely room for audit committee, right? So then if examiner asks you a question about how audit committee can drive, right? Uh, Discipline in financial reporting, some different question examiners are you able to answer. Don't prepare for traditional answer. Audit committee should have X number of directors. Those are childhood questions, right? So, and that, okay, lack of documented policies and procedures, what does it mean? It means the control environment of this company is weaker. So auditor may not be able to rely on controls like that. Then the risk management, if the examiner won't see, the examiner has set the precedent in such a manner that any of the question can be tested. Now, if the examiner wants to test enterprise risk management, be aware that our corporate governance code talks about ERM and what paragraph it is, how to connect it. So those, this slide you can really interpret and have number of questions and answers ready. So I'll be taking those questions with answers. Before that, I want you to test yourself before the exam. Testing yourself at the exam is really costly. The cost is about 6 months of your life. How valuable of our life are you going to waste 6 months? Or test now, prepare now. Test now, fail now, prepare now, and then at the exam be successful. So let us, you download the paper today and try to answer those questions. So that's about that, Dasun.
Right. Thanks, Indunil. In addition to other risk of material misstatements, what I have highlighted, anything that you need
Yes.
to add?
Yeah, I think that's a very good because that part of the let me I'll take the screen for a minute.
Yeah, sure.
Now I think Dasun, while Dasun was explaining some of excellent explanation on some of the accounting issues, and actually I'll tell you what is missing. What is nothing is missing from accounting angle, but what is missing from your side is how do you connect that using the language of auditing. That's the only missing part that you have to bridge to get the maximum marks. Now see, this is the paper that you can download. This is like the actual exam paper from your own pre-scene. Unseen scenario is given with possible exam questions like now I explained to you. Discuss the meaning and importance of stakeholder perspective to governance considering the present issues. Now most of the students, they can't memorize and write an answer. Most students fail in case analysis. How to connect now? When you write this, you can't memorize and write stakeholder perspective, which is in your study pack. But you need to connect to the case study to get these 3 marks. It may be 5 marks. Then recommend 3 main changes to current board to comply with Dirisavi listing requirements. Right? Are you going to scared or Dirisavi? I don't know. Right? I mean, nothing big, but you should know. Outline the benefit of board diversity, addressing the current business and stakeholders. So like that, the question. And then okay, I'm hypothetically saying there is a meeting with audit partner and some issues have been highlighted, right? Including frauds, right? And then someone stated that despite many business risk, company was able to achieve financial targets that you can see their numbers due to aggressive management style and incentive scheme. Now, this again, I'm trying to connect to a bigger topic in the syllabus called fraud. And look at their revenue growth, the competition. Is it, acceptable growth? And like Dasun explained, some of the fair valuation, really you need to question some of the accounting treatment. For example, you can't just capitalize development cost based on the normal criteria. of identifiability, controllability, and separability, you need to have separate testing for it to be recognized. I'm sure Dasun would have explained those criteria, and there is a greater chance of that coming if examiner choose to select evaluate risk of misstatement and give you 15 marks or 10 marks. That's the likely question, right? So that question also I'll come and show you. Now this one I explained to you, answer into Dasun's question, internal control framework using COSA framework, and then how you connect business risk of this entity to risk of misstatement, evaluate for risk of misstatement in addition to business risk, like that. Fraud risk factors using the fraud triangle, ESG reporting related questions, right? Now on Dasun's question about the risk of misstatement, right? In my session, I will give that connectivity. So when it comes to answers, right, I will discuss with you separately, but answering now, see this type of answers, you need to really now start writing. Now is the best time to play. Don't now try to read all the open book, everything. Now, of course, if something is there in the pre-scene, you need to really highlight those and be ready to apply that. Now, see this question that Dasun asked now about risk of misstatement, right? Now, when it comes to risk of misstatement, I was listening part of even today's talk about the exchange gain or loss. Even if a group audit scenario is given, students remember, group audit risk of misstatement is a separate topic. There is auditing standard 600, misstatement in group financial reporting. So when it comes to group financial reporting, there is something called consolidation process. Now, do you know control over consolidation process? If examiner asks a question like that, you get stuck. Do you know the meaning of group-wide controls? Now, see the intercompany reconciliation. If there is a foreign subsidiary, how do we make sure that the currency translation and closing rate properly take place? Right? How do we know the accounting policies before you consolidate? They are okay. The recognition of goodwill and the fair valuation. All of these are misstatement in the context of group auditing. And then in terms of control, I mentioned about the group accounting policy, etc. Now, in addition, this case study, Dasun already covered. You can give a list of things. I just now put few things, right? But I'll take one example. Now, most of the obvious issues given in this case study as risk of misstatement. Number one, you will definitely write RR. Can you tell me what is RR? Why RR is a risk? Please use the chat. And then I am saying PPV. What is V? So that's the language you have to use. V means valuation. What is the issue in valuation? That is revaluation. What is the issue in revaluation? That is what Dasun explained to you. Right now, but the revaluation issue, how do you write in risk of misstatement language? For that purpose, you have to use the right language. Now, you see, to explain any risk of misstatement, we can use these words, two C's, right? Either it is complex, right? Complexity, or it is a change in the business, or it is uncertain, or there is a management bias. That M is very relevant in this case study, or subjectivity. When you write answer to revaluation, that look here now, this company wants to secure that foreign investor. Make sure that the balance sheet is stronger. So there is obviously management bias where they could overstate the revaluation, right? So then the reasonability of the assumption relating to fair value you need to assess. And that given the current economic environment we are in valuation, there is an inherent issue that we will not get into a proper valuation because the market is not that good. You know, the fair valuation is a separate standard. I'm sure Dasun has explained the importance of active market when you establish the fair valuation. And this deferred tax element, like that few bullet points. Again, if you write half a page on revaluation or one page, you are totally wasting your time. Brilliant student knows how to write 3-4 bullet points and to score the maximum. So this is one point, right? So like that, I also Dasun explained to you a very important point. The recognition of financial assets, especially equity instruments, if they have, that's a very good observation that what happens to finance income. Now, how they have recognized financial assets, right? Is it used in fair value P&L or OCI? What is the model? And that if it is an unquoted, is it an unquoted? Is it given us on whether quoted or not quoted?
It was not mentioned in the question. So even if it's unquoted, the normal expectation is to measure at FVTPL. So where you can't find out the fair value gains and the losses in the P&L.
Yeah.
And even in OCI, you can't find out the fair value gains and the losses.
Yeah, exactly. So that has a big point for auditing, right? See, if it is a quoted or unquoted, as you know, if you apply fair value standard, so this question of the observability of valuation, the relevant data really matters, right? So the more unobservable input that goes into valuation is going to make it more subjective, right? And this word estimation uncertainty is very high. So inherently, that valuation is prone to misstatement. Now, if you use those language only, you will score. Remember, just because you know accounting standard, you should be able to articulate, right, in a language that how it could overstate either from fraud point of view or complexity point of view, right? So complexity can arise due to these things, right? This C is a complexity and SC is a subjectivity, and specifically this word estimation uncertainty is coming from auditing standard 540, audit of fair value estimates, right, and measurement. And that it is connecting to fair value directly. This standard is connecting to the I knew study text briefly. This is connected to fair value accounting standards, right? Those level 1, 2, 3, the observable, and all of these things you should be able to concisely, right, bring to your answer without writing unnecessary lengthy answer. So many issues you can identify from this pre-scene, right? Revenue recognition, PP, and then intangible assets, especially R&D, capitalization, and now we spoke about financial asset and income recognition. So like that, there are a few others that you can easily identify as risk of misstatement. Now, if you are a brilliant student who wants to get the prize, let me to put it in that way, right? Most students struggle to pass this exam, but I'm talking about a prize win because it's so easy, right? Dasun will tell you compared to past AFR paper or a global standard. This, I don't think financial reporting also here is a highly complicated one, but I'm sure it is our standard paper. But then if you remember you are on the verge of becoming chartered accountant, you should be advisor to the board and read behind numbers. So that is read behind numbers and advise the board. That is where this governance, the internal control architecturing skill, the risk skills, right? And to be sensitive to ethical issue, then you become all-rounded chartered accountant. And that is why this is called ABR and not AFR, right? So I think that's all I have to say, Dasun. So I will, if you want to be a prize winner, so getting 50 is nothing, right? Be a serious student, download this, answer this, and try to use the accounting standard knowledge that even this session and Dasun has done several sessions, use those, the accounting standard knowledge to answer these questions. I think that's all I have to say, Dasun.
Right. Thank you, Indranil. Very, valuable explanations for the students, the connectivity in terms of the financial reporting and risk and governance part. So students, that's the end of our session.